Hello, I'm Cynthia Cruz, and today we're going to be talking about ESG and diversity. And I have with me today Stephanie Hildebrandt and Kristen Burns, both who are partners in the BDC group. In addition, we're joined today by Hannah Orowitz, who's with Georgeson, and she works on the ESG advisory team and is a managing director at Georgeson. The reason we're talking about ESG today is because of the significant shift I think that everybody's felt in the past year. There's been a huge acceleration in focus and interest. And the SEC definitely is putting out additional rulemaking to make sure that there's more transparency. So we want to talk about what environmental, social, and governance means today. Hannah, can you introduce the subject to us?
Yeah, I'm happy to. And it's seemingly a simple question, right? What is ESG? But it's actually one of the challenges in this space is that there isn't a universal definition of ESG. But for purposes of what we're talking about today, and sort of approaching the topic from the viewpoint of the institutional investor community, which is, I think, who we're primarily concerned about today, it's helpful to think about it as this is the range of risks and opportunities that a company faces that historically weren't necessarily considered to be financially material, but increasingly are being considered as having a significant potential financial impact on a company's long-term value. So that's sort of the viewpoint that investors are taking in coming to this topic. So you sort of think about it as the value creation standpoint as opposed to sort of the impact standpoint of a company's impact on the environment or impact on society. And sort of that can be an undercurrent sometimes, but really long-term financial value impact is what institutional investors are thinking about. So in terms of the key topics that surface with that definition in mind, it varies, it depends on industry and issuer, but a couple of the key themes that have really been top of mind for investors somewhat universally, sort of looking on the environmental front, things like climate change, on the social front, diversity, equity, inclusion, which we're going to talk about today, and more broadly, human capital management. From governance standpoint, I know that's probably the most familiar to everyone listening here today, but you're thinking about not just your traditional governance issues like your board structure, but also one area that investors are particularly interested in currently is sort of the governance of E&S. So what is the oversight structure in terms of how companies are approaching these issues?
Thank you, Hannah. I'll jump in with a question now too. That was a good kind of background and why we're thinking about it. Can you give us a little bit more detail, maybe specific to the asset management industry and why it's important to that industry as a whole?
Yeah, so I mean, it's a good question. And I think, two sort of big trends that I would think about in terms of why this has become such a focus with sort of the institutional asset management community. I point to two things. One is that we've seen this shift over the last 10, 15 years to passive investing. And with that, with these large institutional owners that are universal owners, they're really dealing with systemic risk at this point. The principle that probably a lot of us talked about when we took securities law in law school, right, was this idea that you vote with your feet. So if you're not doing, you divest. But when you're a universal owner, you can't necessarily do that. And when you have strategies that are following an index, you stay in the stock. So sort of the place this is coming from is the idea of sort of rising all tides, right? Or a rising tide lifts all boats, I think is what I'm trying to say. But that idea that sort of you're going to remain in the stock, so what can you do to try to address those risks? So that's one key area that's impacting this. And then the other thing I would point to is really the UN Principles for Responsible Investment. That's something that's been around for quite some time, but has gained a lot of momentum, particularly in the past several years. And that is a set of responsible investment principles that really asset managers at this point are sort of effectively required to sign on to if they want to get sort of institutional asset owner mandates to manage money. And what those principles entail are focusing on how a company is managing these types of risks. So sort of those streams, I think, are really driving asset managers to be focusing on these topics.
Right, and you mentioned the UN and their framework, but there's actually quite a few frameworks out there, and they can be focused on different things and a little bit confusing. Can you just maybe talk about some of the different frameworks or what they might be focused on? I think there's 5 of them today that are the main, are the primary.
So I mean, it's a good question, and I think sort of the result of the focus on this is that investors are really driving for comparable data across companies, and that's where the voluntary frameworks come in, is that there's this desire to try to have apples to apples comparison, and in the absence of having requirements to disclose this, how do you get that information? And I think you're right, Cynthia. So we did some research around what frameworks and standards investors are really focused on at this point. We identified in that research, it was a global look across 400 of the largest institutional investors, and we identified 5 primary frameworks that we were really seeing consensus around. That narrows much further once you get into like specific geography and your specific investors. But those are things like the CDP, which was formerly the Carbon Disclosure Project, which, as its name suggests, is more climate focused. The TCFD, the Task Force on Climate Related Financial Disclosures, that's a framework that's been around for several years and is a 4-pillar structure that's focused on governance, risk, strategy, and then metrics and targets with respect to a company's climate oversight. There's SASB, the Sustainability Accounting Standards Board, that's industry specific, that is really been developed with an investor view in mind. Investors were involved in the development. There's strong consensus in the market for that one. The IIRC, International Integrated Reporting Council, and then the last one that we saw a lot of support for was GRI, formerly the Global Reporting Initiative. These all have different approaches in terms of what kind of information they're hoping to elicit. As I said, some are topic specific, some are industry specific, some, like GRI, is looking more at a company's impacts than the value creation standpoint. But those are sort of the key ones that companies can focus in on at this point.
And so with those kind of, we'll talk about the 5 groups that are kind of setting these standards, basically. Who's monitoring to make sure that a company or an asset manager is actually meeting the requirements? Or is there somebody monitoring that, or is it a free-for-all?
That's a good question. So I mean, with asset managers in particular, and for BDCs, I think going back, the UNPRI is significant. There is a reporting mechanism around that for companies that are signatories to it, where you report on the activities you are doing to uphold those 6 principles that I mentioned. Sort of beyond that, nothing here is required, but there is also the sort of the rating and ranking universe out there, which isn't necessarily holding anyone accountable to any one of these frameworks. Each one, to further complicate things, right? The ESG rating universe that's out there, they each have their own sort of weighting system, their own prioritization of issues. So it's something that's actually very frustrating to the market, and is something that has led institutional investors to create their own sort of proprietary platforms, because there's very little correlation between the scores. So some of the big rating providers that you might have heard of, someone like an MSCI or a Sustainalytics, you could have an A on an MSCI rating and be, high risk, have a score in the 40s on a Sustainalytics rating. So, it's a challenge to sort of manage all of those. The maybe good news in that is that, we looked at this question as well across the investor community to get a sense of who's using what. Investors are heavily using rating platforms, not necessarily for the rating though. They may be using it as a data collection tool. So it's important that the data they're pulling is accurate, but your score maybe doesn't matter as much unless you're trying to get into an index that's linked to that score. But there's hundreds of these products. We identified 39 that we saw investors were using, and that number again narrows pretty quickly once you look at particular investors. So if you know your investor base, you can identify which ratings they are most heavily relying upon for purposes of sort of whether it's picking investments or from sort of a stewardship standpoint in terms of who they might be prioritizing engagement with. And then, like I said, there's this proprietary platform evolution happening. About 40% of the investors that we looked at actually have their own internal rating system that they're using.
Yeah, we actually did a survey of the participants in the roundtable for the BDCs, and what we got back was that it was important and people were getting into the ESG area, but it was outside the top 4 issues that they're concerned about or keeping them up at night. They were very much focused on the fact that the advisor, so if you're talking about going with an advisor, then a large platform, likely you're looking to them and looking to their program. But what I did see was there's a bit of wait and see on what the SEC is going to do. But what I think that you're focused on, Hannah, was the fact that the data collection, no matter which framework you're using, the data collection is going to be incredibly important to you. And so at the end of the day, no matter which one you choose, you should definitely start looking into this and planning and creating a strategy. So, and this leads into, go ahead.
Oh, no, sorry, go ahead.
Well, I was just going to say, so one of the focuses is, and the reasons to get involved in the ESG area in the planning is that you're going to see investors or stakeholders potentially putting forward proposals that might have to end up in your proxy statements that might go to this. What have you seen in the past year with proposals?
Yeah, so it's a good question. I mean, this has been a pretty crazy year in terms of the shareholder proposal landscape. And sort of in addition to shareholder proposals, also there's been an impact on director elections linked to sort of ESG oversight and management, I would say. But so from a shareholder proposal standpoint, some pretty unprecedented results. We saw 35 environmental and social proposals passed this season. That's a really high number. That's about 50% higher than what we saw in the prior season. And sort of if you look at the 4-year trend on that, we were at less than 10 proposals in each of like 2018, 2019. So it's been a big jump. The sort of looking at some of the topics, like breaking that down, on the environmental side, there were 14 proposals that passed. If you look at that in terms of the number that were voted, that's more than a third, I think, of the proposals that voted passed. So that's a really high passage rate compared to what we've seen historically. And the average support for the proposals was also very high. It was in sort of like the 44% range, I want to say. So very strong support. We saw some record high support for sort of specific topics, highest we've ever seen on plastic pollution. And what was also interesting on that proposal was like the year-over-year trend. It was a proposal that had been voted on in 2019 and got more like 6% support, and then at this season over 80% support. So it's really demonstrating the huge shift in terms of how investors are thinking about these topics as material issues. Similarly, on the social front, very, very strong support for those proposals. And we also saw some unusual, I would say, activity in that there were companies that decided to put forward environmental proposals this season where they'd maybe been approached by a proponent with respect to climate and decided to put the proposal up themselves, or where they had a shareholder proposal and the company recommended votes in favor of it. That's something that I don't recall seeing in the past. on some of these E&S issues. So there's definitely a significant shift underway. And, you know, looking at like BlackRock, for example, they supported almost half of the E&S proposals that they voted on this season, which is a sea change from what their numbers were if you look back at like the prior season.
Right. Yeah, and then you also mentioned it as far as directors, you had the Exxon, which there's obviously been people working in that area for years, but they had a successful campaign against some of the directors. So this has just not occurred really in this area. So
right.
In addition,
yeah, no, I mean, Exxon was pretty remarkable, both in that the strong support that the dissident slate received from institutional investors. And there was, I mean, I don't think we have time to get into it, but it is sort of a notable case study in terms of the confluence of some of these ESG issues and how that played out. But sort of beyond Exxon, we did also see instances where there was voting against directors for companies sort of not having sufficient disclosure on E&S issues. And going back to the frameworks that we were talking about, some of the large investors like Vanguard and State Street and BlackRock have been vocal in their support, in particular for SASB and TCFD, and are in some cases now voting against directors where companies aren't progressing their disclosure.
Yeah. One of the most interesting things I saw was the proposals are being put out, say on climate, which will be more strategic and describing it. But I just thought that was an interesting play. But in addition to some of the proposals, where's the SEC on these issues, Stephanie?
Yeah, so the SEC has been fairly vocal on their thoughts on this, maybe not into granular detail yet, but I think that's coming. As many of you know, earlier this year, then acting Chair Allison Herron-Lee launched an ESG campaign. That was in March of this year. And the SEC at that time announced the creation of a climate and ESG task force, but it was within the division of enforcement. So they are looking at this potentially from an enforcement perspective. The task force stated its mission as being to focus on identifying misstatements or material omissions in disclosures of climate risk, examining disclosures and compliance issues related to investment advisors and companies' ESG strategies, and then also evaluating whistleblower complaints related specifically to ESG concerns. The SEC at that time, or in particular, Chair Lee said that this was the most pressing issue for her to ensure that the SEC was fully engaged on confronting the risks and opportunities that ESG posed to investors, financial systems in the economy. So I think that, you know, it goes with what Hannah was talking about, investors being focused on it. The SEC is seeing that and taking action, or at least talking about taking action. The SEC in that regard also in March was seeking public comment and public input from investors and issuers and other market participants to assist the SEC in shaping their ESG disclosures, noting that in the past 10 years, there's been demand for this. And I think, again, Hannah noted that when she was in particular talking about the proxy season and proposals and the shift over time there. Now that Chair Gensler is in place, he has stated publicly that he's going to continue this campaign. And then the White House has also tacked on. You know, the White House issued an executive order in May where they basically said the order was going to advance consistent, intelligible, comparable, and accurate disclosure of climate-related financial risk, including both physical and transition risk. And I think what they're really focused on is they want to see what the financial risks are to the stability of the US financial system when it comes to ESG. So with all of that, like I said, I think there's more to come in the coming months and certainly in the coming years, but they are really focused on it. And with that in mind, Cynthia, can you talk about what the Division of Examinations has done in this regard?
Sure. Back in April, there was a risk alert that was put out that went to what the division thought was some of the deficiencies that it had seen when it had looked through various advisors and funds and their ESG products or practices. The SEC indicated that basically, as a result of the number of products, the lack of standards we've been talking about, created kind of a compliance risk. And what they identified as far as the deficiencies were effectively, they didn't think that there was sufficient policies in place for folks. In addition, they didn't have the documentation that would clearly state how you would determine whether you were meeting the ESG standards. And then you had some differences between what your compliance program said and what your disclosure said. And all those things were things that they were highlighting as problematic. And then they said that effectively anybody who's using ESG as part of their investment process really needs to be careful on how they're describing it, and they need to make sure it's included in those policies. I can say what you're really seeing as a result of the SEC's issues comes through in some of the comment letters that came through. There was about 3,000 pages of comment letters on the proposal the SEC had, or the questions they had posed. They were talking about, what was the authority of the SEC? Should they really be doing this? What should the standard be? Should it be qualitative or quantitative? What kind of liability would attach to it? And even, should it be audited? Which is a little concerning. But anyway, we're expecting something more, a proposal from the SEC that's going to hopefully hit all those points. I would say that the commission isn't necessarily completely, cohesive on this. There's some of the commissioners who think this is a high priority. There's other ones, if you want to read something interesting about some divergent thoughts, Hester Pierce put out a speech called Chocolate Cicadas. And if you listened, if you lived through the DC summer, you'll appreciate that speech even more. But she goes through some of the issues she sees around how to make rulemaking in such a broad area. So it's there's a lot going on at the SEC.
So Cynthia, with all of that in mind, with so much focus on it, and then with divergent thoughts, as you've talked about, on the importance of ESG, what should BDCs and their directors and their management teams be looking at?
Yeah, just focusing on the directors. Directors really need to make sure that they're getting information from their advisors or management teams on what are they doing, what is the overall strategy for your ESG products, what have you done to get that inserted into your compliance program, and then one of the good ways to understand that. So, for example, if it's a part of your investment process, ask the management team to give you a case study. How did it affect a particular investment? And that, I think, gives you a good understanding of how far along they are in their thinking. And then make sure that your disclosure is consistent, as the SEC said. So it's, I think that this is something that the boards are really going to have to spend some time overseeing the process, but really the work's being done at the management level. And I would expect that this is, we've heard that there's, the $64 million question. This is what I saw in a quote, this is the $64 trillion question. And it's going to take even more than 10 years to get this all figured out and get a program in place. So just to, when I focused on the board, one of the other areas that is come up is the whole issue around diversity and board composition. In the SEC, there's been a fairly significant debate on whether that should be mandated in any way. And so the SEC did approve a rule for Nasdaq and for board diversity. And Kristen, can you maybe explain whether that applies to BDCs and what the requirements are?
Sure. The Nasdaq Board Diversity Rule does apply to BDCs. Under the rule, beginning in August of next year, 2022, Nasdaq will require each Nasdaq-listed company, subject to certain exceptions, to publicly disclose in an aggregated form information on the voluntary self-identified gender and racial characteristics and LGBTQ+ status of the company's board of directors. There's a sort of a phase-in transition period, and subject to that, Nasdaq will recommend that each Nasdaq listed company have at least 2 members of its board of directors who are diverse, including at least 1 director who self-identifies as female and 1 who self-identifies as either an underrepresented minority or LGBTQ+, and both of those terms are defined in the rule. If the Nasdaq company doesn't have 2 such diverse directors, they will have to explain why they don't. And as I said, there is sort of a phase-in period. So the requirements for Nasdaq listed companies are, first, to disclose a board diversity matrix beginning in August of 2022, and then have at least 1 diverse director, or explain why you don't, by August of 2023, and then 2 diverse directors, or again, an explanation of non-compliance, by either August of 2025 or August of 2026, depending on which sort of tier of Nasdaq you're listed on. There is also an exception where companies with 5 or fewer directors can meet the diversity objective by having or explaining why they do not have 1 diverse director by August 2023, or whenever they filed their proxy statement in 2023. So there is time to meet the requirements. And the Nasdaq rule will require the Nasdaq listed BDCs to annually disclose, as we discussed, certain statistical information related to self-identified gender, race, and LGBTQ+ status. So Cynthia, where do you think the Nasdaq listed BDCs will include this disclosure?
Yeah, so the rule requires it either to be in the proxy statement or on a website. And if it's on the website, you have to send that information also to the NASDAQ. And so it's going to be interesting how that all comes together. You're not only going to have to disclose your current diversity composition, but also the previous years. And you're not currently required to include anything regarding your human resources or work, your management or staff. That's something that we'll talk about in a minute. But that disclosure and how you disclose it, there is a matrix that the SEC, not the SEC, NASDAQ put out that you can use. You don't have to use that. I would imagine that most people are going to ultimately use some type of matrix to do the disclosures. So it'll be interesting. And one of the issues is gathering the data for the disclosure. And making, how are you going to get that, whether you get it through D&O questionnaires or how you're going to go about putting this all together, I think is going to be one of the things you have to focus on. And Kristen mentioned if you don't have a diverse board, you're going to have to explain why. I think you're going to have to be really careful when you start making those explanations in your proxy or public documents. I think really the key here is you really need to make sure you start moving down this road, because whether it's the SEC, NASDAQ, or one of the proxy solicitation firms, ISS or Glass Lewis, or even one of the states like California or Illinois, who are requiring certain diversity requirements. This is coming. This is not something that's going to go away. But what I will say is the NASDAQ rule has already been challenged. Kristen, what happened there?
So the Alliance for Fair Board Recruitment, which is a nonprofit membership organization that has previously taken legal action against California over its requirements for board diversity. In August of this year, they filed a petition for a review of the SEC decision approving the NASDAQ diversity rule. And in the petition, they claim that the board diversity listing rule is unconstitutional because it will compel companies to illegally discriminate on the basis of race, gender, and sexual orientation when selecting directors. The first deadline for compliance with the rule is not until August of next year, so we'll certainly be monitoring the outcome of this petition and any other legal challenges to the rule to see if they impact the timing or the terms of the rule.
And Hannah, what kind of proxy activity did you see this past year?
Yeah, so you'd mentioned the sort of the list of parties that are sort of driving this. Investors are also very much in the mix in terms of their interest in board diversity. A lot of them have guidelines in place already in terms of their expectations, more so on gender diversity than on racial and ethnic diversity, but we're seeing that start to come. And it was a major reason for why investors were voting against directors at annual meetings this year, was where they found that the company board was not sufficiently diverse. We saw some board diversity related shareholder proposals pass. There were 3 that passed this season, including one sort of going back to the record setting that I was talking about. Here too, that proposal got over 90% support, so very high support on this. Sort of looking beyond board diversity, workforce diversity was a real significant issue for the proxy season. And a lot of that, the proposals that went to a vote were very highly supported, but a lot of the activity around workforce diversity took place really outside of the 4 corners of the proxy ballot this year. There were some very successful letter writing campaigns from the proponent community. The New York City Comptroller's Office was probably the most public. They targeted companies that had made statements sort of supporting the need for racial justice or Black Lives Matter movements, and sort of said, show us the progress that you're making on this. And it was essentially a call for companies to disclose their EEO-1 survey data. So that's the information on the breakdown of your workforce on the basis of gender, race, and ethnicity at different levels of the company. And sort of the result of that campaign, it was a pretty minority practice going into the proxy season for companies to disclose that data. It's now a significant majority practice within the S&P 100, and we're seeing a lot of companies that we're working with, even small caps, that are disclosing that information in their current ESG reporting. So it's definitely an area where we're seeing a lot of movement.
Thanks, Hannah. Cynthia, besides the SEC's recent approval of the Nasdaq diversity rule, is there any indication that the SEC itself is considering requiring diversity disclosure in public company filings?
Yeah, I think the most activity you've seen here, especially for funds, is in the Asset Management Advisory Committee. This goes beyond just the board diversity. This goes into again the management teams and staff, what the gender and racial diversity are. And what you've seen is that the committee came out with a proposal and said that they would like to see some data in the actual Form ADVs in order to provide some transparency regarding the gender and race. And they want it at kind of the workforce level, the officer level, board, and then advisor. And they even went on to say that they'd like to see it with some of the consulting groups that the fund may work with. So there's a variety of factors that they focused on there. And Chairman Gensler jumped in on this and said that, and just to emphasize that this was something that was important, is that he said that the asset management industry has a lot of work to do to increase racial and gender diversity. So this is kind of a first step, I think, and I think you're going to see rules coming into play, and that making sure that you have the ability to gather that data is going to be important, and it's the best thing I can say is it's coming. So, and I think that's probably the best way for us to wrap that up on this topic, or at least for today. We can certainly talk about this all day, and there's a component of this that goes to cyber as well. But we'll wait to do that another time. So anyway, we appreciate everybody joining us. Thank you very much to the panelists, and we'll talk to you soon.